Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our frac spread show. So we're going to talk about the frac spreads, and we want to talk a bit more about what's happening in natural gas right now, what's happening with NGLs, and then diesel and the refined product side, because we're seeing a lot of movement. And it's obviously going to come back to what is our production going to look like? What is our activity going to look like? So when we look at the Primary Vision frac spread count, we went from 295 to 298. And if you remember, our view is that about 300 is the right number. So we're really approaching this I think flatlining, if you will, of activity, where we're going to see a pretty steady number at this point. Now, within the data itself, it's going to bounce back and forth. Like, is the activity going to be in the Permian or Appalachia or Anadarko? And that's where you're going to see some fluctuation. But realistically, we're going to see a pretty consistent move as we go through the remainder of not only just October, but then the beginning of November. And the big piece that we really want to look at is the Haynesville and what happens as you get Freeport coming back online, and just given where the LNG market is. We know China has come out and said they're no longer going to resell some of their LNG. They want to make sure that they have enough for the winter. And again, they could easily turn around and start reselling it once they're comfortable. It's not to say that they're out of the market, but again, you're starting to see a bit of concern, especially when you look at where diesel prices are, where middle distillate is around the world, especially when you look at both Europe and the U.S. East Coast. So that's when you start looking at some of these different structures. But even in this backdrop, we don't see a move that's going to take us above really 300. Could we go to 305? Sure. I am by no means saying that we couldn't see some of that movement, but we're not going from 298 to 325. Like, that is just not in the cards at this point in time, not only just based on the activity that we're seeing, the available horsepower, but also just what is the market going to tolerate at this point in time. And that's why we really think we're going to see some of that capping. Now, when we look at just the drilling side, here you can see that there was an increase of 2 oil wells. And when you look at the different breakdowns, the horizontal wells increased by 3, with vertical going down by 1. So we still see a very continuous move up in the horizontal side, which is really what we've been talking about. You know, on the side, we talk with different clients in terms of where we see the horizontals really going out. And we're getting closer to our target number when you start looking at, again, bridging that gap and making sure that there is enough workable inventory as we go into next year. Now, when you look at the natural gas side, so obviously we've had softness come into the front month when you look at where things are, but I think it's interesting when you look at the one that we have, the orange, which is today. You have the green, the blue, and the red, which is over the last, going back from July to now. And then you have the white, which was 3 years ago, from 2019. And you get an idea that even as the front month has come down, there is a lot of stability in terms of where we are between a $4 and $5 basis. And again, there's always upside within that. But when you look at the $4 to $5 base, that's where we see a lot of staying power, just not just because of Russia and Ukraine, but really just based on where the market sits today. There's clearly a diesel problem. There is a middle distillate problem in general, but there's also the availability of the oils that are high in disti. We are running short on those oils. So the biggest focus at this point is, how do we make sure that we're increasing the usage of natural gas, pipe gas, and LNG? And that's where we have to incentivize that. And that's where I think you're going to continue to see some of this activity. France pulled in the most diesel in a very long time. Obviously, with the strike, as that is ending, they should slow down a bit. Italy increased the amount of oil they brought in, and that was just, again, bridging that gap with Libyan crude. But the big focal point will be, where is gas at this point? And we've said from the beginning, we think $4 to $5 is a very comfortable place to be when you're looking at the longer term. Obviously, you're just going to have the backdrop of Russia. That's not ending anytime soon. There's going to be a lot of complications within that. I spoke at an event last night. If I had to say how much longer does Ukraine-Russia take place, I think if you said 18 to 24 months, you wouldn't be wrong. But as we know, war is war. A lot of things can influence that. But again, there is a lot of staying power, which is going to support a lot of this curve, especially if we have a cold winter. If we have a cold winter, I would assume a re-rate higher, at least in the front of the curve. With the belly, I think when you look at over the last, since July 21st, you haven't had a lot of mobility in the front, which is, I think, a good thing because it's showing that staying power and where we're going to sit at this point in time. Now, when you start looking at the NGL side, as the petrochemical market has come under pressure, as you've had an increase in supply within the U.S. and that slowdown in petchem, you've had some of that pressure come through. Obviously, we're also in shoulder season, which is going to influence propane more than anything else. But as you start to get propane coming back, as you start to get some of those purchases, I think, as we've been saying, you flatline to a point where you have a lot of this flattening in the price side, but that doesn't mean that the frac spread. Now, there's the completions, the primary vision frac spread, which is the fracturing of oil and gas wells. And then there's the frac spread at the midstream, which is when they're taking the raw gas, the Y grade, and they're going to break it into its pieces of methane, ethane, propane, butane, isobutane, natural gasoline. That's the other frac spread. So when you look at the frac spread, so you look at pricing, you're like, oh, well, pricing isn't terrible. I mean, it's not where it was, but it's not back to 2020 levels. But the thing is, it takes power, it takes natural gas to do that. So when you start looking at your input costs, which is electricity, which is that's gotten more expensive. So your actual spread has gotten much worse, even though the prices of its components haven't come back to those levels. So that's the important thing to look at, which is why on its basis, we see this being fairly firm or at least stagnant at this point. Obviously, there's going to be a bit more pressure, and it's all going to come down to what happens with the petrochemical side and the exports, which is why I'm more confident in propane, where ethane, you can get more ethane rejection. We do have that continuous export now, which will keep the floor a bit higher. But again, that's where we see some of the pressure, while diesel, the crack spread, when you look at it, is now well above $80, and there is a lot of staying power. Does it stay at 80, or above 80? Who knows? You could say sure it does, especially going into winter. But when you look at the congestion over the last couple of months, there is a lot of staying power at that $70 level. And that's where we see a lot of that capacity, especially given where we are on the storage side in both the US, but also on a global level, which we talk about here. When you look at the different levels, when you look at Singapore, you have Diwali. So the Diwali festival is pulling down some of that gasoline. That will then get reversed once you have the end of the festivals. You do have more of that capacity coming from China. But look at middle distillate. You went from 8.1 to 7. Again, some of that is Diwali as well, but you're not making any real traction on filling that middle distillate void, which is going to keep margins where they are, going to keep people active. And then when you look at Europe, same thing. Gas oil had a small draw. You're not seeing any meaningful build on the middle distillate side as we go into winter, which is going to keep that crack spread healthy. The question is going to be, where is the gasoline crack spread? And that's really going to make the decision of when do we get the pain on the economic run cuts. Obviously, diesel will factor into that, because if China dumps, then you'll get some of that. But the distillate crack is always going to be positive over the next 3 months. It's just going to be how positive is it and how negative is gasoline. And that's going to make that decision, which we do see some of that risk in the Asian markets, depending on what China does, how quickly they export. And that's going to be an interesting backdrop. But here you can see we are clearly in a based on where middle distillate is, where diesel is, there's going to be a lot of support for that natural gas curve at these levels, which again is going to keep the U.S. fairly active when you're looking at natural gas production, which will throw off NGLs. And with petrochemical where it is, that's going to come under pressure, still positive, and it'll get better as we progress through winter. But these are some things that we're looking at and paying attention to. So hopefully this was helpful. If you have any questions, please let us know in the comment section. You can find me on Twitter. And as always, we hope you have a great weekend, and thanks for watching. I'm Mark Crisano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.